Hi, Sanford Coggins here, and I want to send you a snippet from a webinar that we had last week with our investors that turned out really well. I answered some questions, brought up some ideas, and explained some things that I thought were very helpful. I'm going to send you a snippet of that now so that you can take a look. But before we do that, I just want you to know that we think about you and are hoping that your family is not just surviving, but thriving through this COVID experience. And now with the vaccines being deployed, I just pray that you're able to roam freely throughout the country and do your vacationing the way you always have in the past. Look forward to seeing you and talking with you at some point in the future. Give me a call if you have any questions about what you're about to see next.
I think that for the most part, what I think you need to know is this. In the way the fund works in Fund 4 is one of two ways that people invest in Visionwise Capital. The real big aha for us in the last 9 months is something called a sidecar relationship. The sidecar relationship goes alongside of the fund and invests separately from the fund. Here's how that works. If you're in a sidecar relationship with the fund, you're after growth. It's a 12 to 18 month turnaround because that's how long it takes for us to flip a building. And in that 12 to 18 month period, you have your own operating agreement, you have your own LLC structure, you have your own investment criteria and terms, if you will, that are consistent with what the fund offers, but you're investing alongside of the fund. The benefit of that is you now can invest in one specific property as opposed to a diversified portfolio. That's not for everyone. But for those who are more savvy, those who want to underwrite their own investments, those who really would like to cherry pick the deals they invest in, that's a tremendous opportunity for them to come in and invest in Visionwise Capital's work to turn the property and make a profit for them in that sidecar. Now, that is a growth investment because it doesn't pay income during the period of time that we're renovating the property. But the fund, on the other hand, is magnificent just for the other reason. In the fund, it's totally an income investment. Let me explain that. I don't think that when we first started the fund, we were thinking in terms of how much income the fund is going to generate. But Fund 4, every time we sell an asset, pays a check to the investors as a form of a distribution. And that check is on top of the 6% distribution that you're getting annually anyway. So let me say it differently. You have the Fund 4 generating quarterly distributions starting in the third quarter of this year. He has to incubate a bit. Some of you are saying, well, I haven't received a check if you're in Fund 2. And the answer is, well, you have, but you haven't received all of them. You're not caught up yet. Give us time. We've had a pandemic to work through. I've had to manage cash diligently. And frankly, given the opportunity to buy an asset versus make distributions to investors, more often than not, I'll apologize to the investors because of the opportunities that we'd be giving up if we didn't invest the capital. So that's what we've done with the money. We've bought 4 properties in the last 6 months and not made all the distributions. Why? Because Fund 4 is maturing starting September of last year. By 1 year out, we will be flush with cash and be able to make those distributions. But know that every 3 months, you're going to get a check that's going to represent about 1.5% income on your investment. But that's not all, because then when we sell an asset, which we expect to be 2 or 3 a year, that's going to be another check that you receive on top of that 6%. But here's the tax break that I want you to make sure you're clear about. As a Fund 4 investor, and again, I'm not talking about the sidecar now, just the Fund 4 investor, when you receive your distributions, it shows up on a Schedule K1 under box 19, which is for distributions. But what's key is that distribution is counted against your capital account, which means that you're getting principal back. It comes out as 6% against your principal or on your capital, and it's going to stay 6% on your original capital amount. But it's not treated as a taxable income on your tax return, which is the power of real estate, the power of the way this fund structure actually works. That means then that for the first dollar out, until you get all of your capital back, you're not going to pay any taxes on the distributions. It's income without taxation. After that, then you're going to start getting the profits from the investments, and then it's going to be taxable. But that may be 2 to 3 years away, where in the first 2 to 3 years, you're going to be receiving income on a tax-free basis. If you have questions about that, let me know. That is so powerful. And what that means is, if I put $100,000 into the fund, Fund 4, I get a $6,000 distribution paid in quarterly increments. But on top of that, I may get another 2 or 3 or 4% income on that same $100,000 in the same year and not pay taxes on the distribution. The next year, same thing. I start off getting my $6,000 base, and then I may get another couple of checks for another 2 or 3% for an 8% return again on the same $100,000. But as I'm doing that, my capital base is being depleted. My tax liability is zero. And now once that capital base is down to zero, I have all my money back. Now I start getting pure profits from the fund four. And it's like infinite income, infinite return. No capital base left, but I'm still getting checks. Let me know what questions you might have about that. It's a tough concept, but it's not very complicated once you understand it well.